Hey everyone, thanks for joining us. This is Arjun Vijay, and today we are speaking with the CEO of Whitestone REIT, James Mastandrea. Whitestone is listed on the New York Stock Exchange under the ticker symbol WSR. Hey Jim, good morning. It's good to meet you.
Arjun, it's a pleasure to meet you. Thank you.
Jim, let's start with a brief overview about the company for viewers who are not familiar with Whitestone.
Yes. Well, Whitestone is a publicly traded REIT, traded on the New York Stock Exchange. We really launched it in 2006 from a small shell of assets, about 150 million in size, and some properties that didn't even quite fit into what we do today. Some warehouses, some office buildings. It's sort of a mix of properties. We did an IPO in 2010, and now in 2021, we're at $1.5 billion in real estate, and we're in several of the best markets in the country: Houston, Dallas, Fort Worth, Austin, San Antonio, and Phoenix. And in Phoenix, we're in Scottsdale and Gilbert. And we basically handcrafted this portfolio to where virtually all it is are these retail community centers. And we picked Arizona, we picked Texas because they're business friendly, and we picked the fastest growing cities. So what we do in our company is we provide services to the local neighborhoods or the consumers. And that really service could be a restaurant, could be a hair salon, it could be a cigar lounge, it could be a number of things like a wine pub. And they're all the kinds of things that you wouldn't or couldn't get on the internet. That's basically what the company looks like.
Okay, great. Just to elaborate on that, I found something interesting on your website. You claim to be an e-commerce resistant concept, and I think that is also one of your USPs. Can you just elaborate a bit on that?
It's kind of interesting how these things evolve. Back in 2008, when we were deciding what we wanted to be when we grew up, we began to see how Amazon was taking over the internet. And basically, that delivery system changed the retail hard and soft good marketplace. And we saw that happening very early on. And so the big boxes that have 20, 30, 40,000 square feet that were very popular on Wall Street no longer were popular. In fact, the devastation that happened in the retail industry, what they might call the rag trade, carried over into the retail real estate. So we had a few properties that were legacy properties that replicated that. What we found was when we had vacancies, and I'm saying like, I could use as an example like Toys R Us because they filed bankruptcy and it's public knowledge. But when we had a vacancy similar to that, a large box, the adjacent tenant would get a lower rent. And the reason they get a lower rent is because of the terms of their lease that were previously done before we owned the property. Part one of the problem. Part two of the problem was that they then had the right to say who we put into that new space. That was just, it's new to us now, but it was empty. So we found that those covenants really gave control over the real estate to the tenant versus the owners. So rather than become a Me Too in terms of trying to make our model adjust to the internet, we decided we don't think that's the right place to be. And we designed a model around smaller spaces, great properties tucked into neighborhoods, and then leasing them to tenants that didn't have to rely on the internet to sell their services.
Okay.
So in that ways, we're internet resistant, and our track record shows that. Our earnings have been great. Our compound annual growth rates have been great. All those numbers show it.
Interesting. And while we are talking about that, at your properties, Jim, do you actually see footfalls returning to what it was pre-pandemic?
No, not really. At our properties, well, I mean, in terms of our properties, the growth, we've had better growth than in the pre-pandemic. And because you're dealing with a different type of tenant. In other words, if you own a restaurant or a family member owns a restaurant, or they're entrepreneurs. They have a balance sheet. They have bank accounts. You're going to see them there from 7 in the morning till 11 o'clock at night. You don't see the manager of a national chain there. You see a manager. So what you have is someone who works harder for that American dream. And we're seeing that even working harder than they did before to accomplish their success. That's one of the things we see. The other thing we see is that the restaurants have cleverly figured out, because of the pandemic, that a lot of people like their carryout services. And when you go into a restaurant, if you've been into one lately and picked up a carryout, you'll see on their tip 10, 15, 20%. I mean, when do you ever tip somebody when you go in for a carryout? And now it's helped boost the revenues in these restaurants. So yes, we're seeing some uptick in it. I think it's getting better and better. And I think it's helped us do a lot of things within the company where it's compressed the time frame that we wouldn't have done it previously as quickly. An example for that would be artificial intelligence. We have a great databases of artificial intelligence, and we use that to determine the traffic patterns that we have, not only in and out of our centers, but in and out of specific properties. So we've seen that go up in the mid-teens, the traffic to our centers. What that does, it gives our tenants confidence that we're doing everything we can as part of the overall property to bring in more customers, and they like that. And also they're doing a lot to bring them in as well.
All right, makes sense. Earlier this week, you reported your Q3 results, which was pretty strong. So congrats on that.
Thank you. Thank you.
I think one of the most interesting metrics was the same store non-operating income, which grew 7%.
Yes.
Can you tell us a bit about what were the factors that drove this growth?
Yeah, same store increases were strong. What drives that is part of the secret sauce in our model is that we keep our leases short term, relatively 3 to 5 years. Now, in the retail industry, that sounds pretty short. But if you compare it to the apartment industry, it's long. Apartments are usually 1 year, you have 3 to 5 year lease. And we do that intentionally. We include in that, in our terms, a 2 to 3% increase in for inflation. We have the tenant pay the common area maintenance, the taxes, and the insurance, and that's passed through to them as well. So to give you an example, we might have a tenant that pays $35 a square foot. On top of that, they may pay another $9 to cover the common area maintenance, taxes, and insurance. Well, that $35 will go up, say 3%, and the common area maintenance and taxes will go up whatever they're raised, although that's not shown as, it's showed as income, but also an expense. But it really is a dynamic that helps us show those same store increases. And I mentioned earlier that we turn those leases. We have probably of the 1,600 tenants, maybe 40% come due every year, maybe a little less. When they come due, the terms in the lease provide that either we have the choice, either the rent is at what it ended at or whatever the consumer price index is or the market. Okay, so we're able to capture a higher rent. So if inflation, like today, it's currently running about 5%. So let's say that we have a 3% increase in the leases coming due January 1st. We'll look at the data and we'll look at the market. And if the competing properties or competing types of tenants around us are paying a rent higher than what they have, we get to adjust it to that. So it's been a great mechanism to help us continue to drive that number up. So you can count on our revenues going up at least 3% a year, maybe more.
All right, makes sense. Jim, you have a pretty decent free cash flow profile. After last year's dividend cut, do you intend to raise those dividends or will you opt for a more cautious approach in spending? I'm asking because you're a dividend-focused company.
That's right. No, I see us looking at raising the dividend. We look at it every quarter. The question is, when do we want to raise it? We have plenty of cash flow to do that. I think we've seen things pretty well stabilized now and even starting to grow. We've got some unique things doing with the portfolio. It's interesting because we reduced the dividends because we didn't know how long the pandemic would last. When we did that, our cash flow stayed very strong, and we began to use the extra cash to pay down our line of credit. So our line of credit has been reduced, and our EBITDA to debt is improving really well. So there's a target we have, and when we hit that target, then we'll look at freeing up some more funds to consider increasing the dividend. But you're right, there's three things you look for in a REIT. One is the appreciation of the real estate. The second is the dividend, which is income. And then the third is an inflation hedge. And real estate has always been a good hedge against inflation.
All right, understood. Just one more last question,
Yes.
Jim. What can investors expect from Whitestone over the next 2 years?
Well, I'm a big investor in the company, and I expect it to continue the trend upward. I think it's been very promising for us. I look at where we're trading today, and one of the reasons we're trading at that level is because we've had a contrarian business model, and the market hasn't really understood our business. In other words, the small space, the shorter term leases, the internet resistant. And the reason they haven't understood it is because their mindset was on Wall Street, and I'll give you an example. If you're an investor on Wall Street and you want to buy certain retailers, whatever that retailer might be, Antiller, Macy's, whoever's in that business, that the investment community would look at the REIT and say, I can own the strength of those credits cheaper if I own them in the real estate than if I own them directly. So Wall Street had trained investors to think like that. It's taken a long time for them to think that, to compare it, say, to an apartment model or something with shorter term leases like this. And the market's catching on. I think you'll see it catch on significantly by the end of the year, maybe early next year.
Okay, terrific. So we'll just wrap up with that, Jim. It was really good speaking with you. Thanks again for joining us.
Well, it's my pleasure, and thank you for taking time to talk to me.